So welcome everyone. This is tax law number 4. We are going to have several topics that we'll have, but I don't think it'll be a long night. So we will start with an update on the low income taxpayer clinic. Attorney Rebecca Stavish will be here to walk us through that. We will then move into the PA local deceased taxpayer issues. And we will take a 5-minute break after the deceased taxpayer issues. We'll return and then answer questions that you may have. After the questions, we're going to move on to military. So for anyone who's not planning to certify military, you can feel free to sign off at that point. We will also have questions, any questions you have for Becky on the low income taxpayer clinic, just put them in chat. And before she leaves, Jeff will ask her those questions and we will get answers for you. Just as a reminder, the 4012s and test books will be available through tomorrow around 4 o'clock. They're outside the United Way offices located at 1910 Harrington Drive. We have them on a table, and since they're covered in plastic, we leave them out overnight, so you can get them at any time you'd like. We also sent out today the current out-of-scope document that was in with the presentation deck. So if you have any questions, feel free to let us know. There's a couple of changes that we've noted with the double asterisks. Okay, other than that, we'll turn it over now to Becky to start talking about the low-income taxpayer clinic.
Thanks, Michelle. Hi, everybody. I know I can't see you, but I know you're out there. And I just want to say thank you so much for coming together and doing this, because VITA is a wonderful program. And thank you for giving me a few minutes to actually talk about the LITC at Mid-Penn Legal Services. So for those of you who are not familiar with Mid-Penn Legal Services, we are a legal aid organization, a registered 501c3, and we cover about 18 counties in the middle of Pennsylvania, including Lancaster County. We only serve low-income individuals, but when they qualify for services, our representation is free. You may actually come across people with issues beyond tax. So if you see that they have a landlord-tenant issue, like if they're facing an eviction, if they are in an abusive domestic relationship, we may be able to help. I've listed some of those other things there as well. So keep us in mind if you see someone in need, okay? But what is an LITC? It stands for Low Income Taxpayer Clinic. They are funded by the IRS, but we are not IRS employees. I did see that note about the audio, so let me just try talking a little bit closer to the phone to see if that helps. Michelle, can you hear me okay?
Sorry, Becky, I hear you.
Okay. Okay, good. Thank you. Okay, so sorry about that. Yes, so we are funded by the IRS, but we are not IRS employees. It's just really important to know, because sometimes folks don't want to work with the IRS because they're afraid of them, or they're anti-government. Whatever folks tell me is going to remain under attorney-client privilege, and certain things I'm not going to be able to tell to the IRS. Our staff is usually attorneys, CPAs, enrolled agents, and accountants. But, you know, that can vary from clinic to clinic. So what can we help folks with? We've got all of these different types of issues that we can help folks with. The biggest thing you're going to see is that we help folks when they have a tax debt. So if somebody has a tax debt or they're missing their refunds, please feel free to refer them to us, because we really have different options for folks. One of the things that I'm going to mention is something called an injured spouse claim. You may see this a lot this year, where one spouse earned income and paid all of their taxes, and the other spouse has an old tax debt, or maybe they owe back child support. And because of this, neither spouse will be eligible for a refund. I don't believe that you guys do the injured spouse forms on site, but that's something that we can help with in our clinic, so that they can get at least some of their refund money back that's attributed to the spouse that's not actually the one that created the situation. Um, However, we are limited in some of the things that we will do. For example, we don't actually prepare tax returns, which is why we need VITA so much. So we really depend on your services because it is important that our clients have their returns prepared in most situations. In fact, if we begin representation and the IRS determines that our client hasn't filed a tax return, say maybe 2017, it almost always comes up eventually. Um, we also are limited in the amount of controversy at hand. So if, for example, a taxpayer owes more than $50,000 in one tax year, we're not likely to take that case. I know that seems like a lot of money, but I have made exceptions before, and one really big exception was identity theft. So keep that in mind. And we also don't handle controversies for businesses. Although, as you will know, there's differences between the simple Schedule C and independent contractors that we will help. Again, a lot of things that we help with: audits, examinations, submitting paperwork to stand by the tax return that was prepared, liens and levies, putting folks into currently not collectible status, that type of thing. So the next thing to think about is how we would actually refer somebody to the clinic. You can give them our phone number. The easy one to remember is 844 MPLS tax or 844-675-7829. We do have a website. We're still sort of testing out the online intake system, but I would recommend you actually call for a new client. And in my case, I used to work at VITA, but it's been several years now, so I don't feel like the best expert to tell you this. But when you're working with your clients, you maybe want to issue spot to determine if they could use some assistance from the LITC. For example, if you notice a liability, check with the client to make sure that they have the ability to repay it. If they don't, we can look at things like the currently not collectible status, installment agreements, and worst case scenario, an offer and compromise. The OIC is a program, which I'll talk a little bit about later with an example, but it's for clients who have very little money and are truly unable to repay their tax debts. That's not for everybody, so I'll give you an example later as to what I mean, but those people do exist. Again, there's some probing questions you can try out if you feel like you've got a good rapport with your clients, and it doesn't hurt to make sure that, after your appointment, that you have a plan in place for them. Okay, so one thing I want to mention this year, and this is sort of new because I feel like there's going to be a lot of folks out there who are facing an eviction or who are already homeless simply because of the pandemic. Talk with them, figure out whether they're facing an eviction, currently homeless, maybe there's a large medical expense, and whether there's a tax debt and a tax refund at issue. When there's a refunded issue and this person is facing an eviction or homelessness, we can help. But it's very, very important that you call us as soon as possible because we only have 10 days. That's 10 days to work the case to intercept the refund from going to the IRS debt versus getting it sent to the taxpayer. This is considered a hardship exemption. They aren't very common, but I will say that this happens at least once a year. And it's really great when we can help these people out together. Okay, So up next, I always put this out there. I know everyone's, a little more reluctant to get together, but if you ever have a need for education or outreach, please get in touch with me. I'm always happy to talk tax with folks and maybe offer a presentation to coworkers or community service providers so that they know what we offer. We also love volunteers, which if you are ever interested, feel free to reach out to us. We are working remotely as best we can. So that's very important for you, I'm sure, as it is for me. And then here's what everybody wants to hear, the success stories. Yay, right? Success stories of how we help taxpayers. So I am actually I'm going to report on number 1 second, because that's actually one of the Lancaster VITA clients. But case number 2 is our elderly client who suffered a stroke and owed the IRS a significant tax debt. I want to say it was about $4,000 by the time she reached us, but she owned no property. She was still considered disabled by Social Security, and she was unable to use any of her Social Security money to put towards her tax debt. We created an offer through the offer and compromise process, and we settled her debt for $5. That's fantastic, right? Well, that brings me to client number 1, which I know for a fact that Michelle has worked with this client because I remember talking with her. But she is someone who was reluctant to even submit a tax return because she was afraid that all of the money would be kept by the IRS. Michelle smartly convinced her to submit a tax return, and she got a refund this past year of over $10,000. Well, in the meantime, we had prepared something called an innocent spouse relief application. And she was a great candidate for this program because technically she had a tax debt, but it's our position that that tax debt was not attributable to her and rather towards her ex-husband, who was running a business under her Social Security number. He really, really pulled a number on this woman. And not only was he controlling the finances, he was physically, verbally, and mentally abusive to her and their children. The only way she was able to get away from him was he was sent to jail on unrelated charges, and she finally broke free. She went back to school, she earned a degree, and she was working. And when she filed her first tax return on her own, she learned about the tax debt. Fast forward with the innocent spouse relief application, she is now going to receive over $30,000 in old refunds because the IRS believes her and agrees that she was an innocent spouse and should not be held liable for the husband's tax debt. So $30,000 for one of our clients is amazing. And I'm so glad that VITA and our LITC could work together to help this client out. And those are the people that really warm your heart and make all of this training and technical details worth it. So that's everything I have for you. We always like to leave on a good note. But if you have any questions, feel free to enter them into the chat and I will do my best to answer them.
I'm not seeing any questions. Jeff, do you see any questions for Becky?
No, I don't.
Oh, I do have one that, Becky, there's a question that says, aren't there other federal numbers for home evictions that we can offer in addition to Mid-Penn Legal Services? No?
Good question. I'm not sure about the other options, but I know that in addition to what I can do with the tax relief, there's a special program that we help folks, excuse me, fill out an application for Pennsylvania funds. I know the woman's name, but I don't know the number offhand. So I'm going to give you the main phone number for that. Because when folks call mid-pen, they're going to be answered by someone who works in our central intake unit. And the CIU folks know who to send everybody to. So in Lancaster County, the phone number you want to call for that eviction and grant assistance for folks facing eviction or mortgage foreclosure is 800-326-9177.
And then Becky, there was one other question. Where is your office located?
Good question. So I am usually in the York office, but we also have a Lancaster office on North Queen Street. And then we have an office in Reading. We have one in Harrisburg as well. Those are usually the closest to you, though.
I think that's everything then, Becky, that we have for you. Thank you so much for sharing, especially that great success story, because I wasn't aware that she got that great amount back. So that's wonderful.
Yes, and I think you know who I mean.
I know exactly who you mean. And I'm thrilled for her. That was a great opportunity to get her fixed there.
Yeah.
All right, so we're done with that piece of it. Jared's now going to share his screen and get started with the Pennsylvania portion of the presentation. Thank you, Becky.
Thank you.
All right, good evening, everyone. Hopefully everyone is having a wonderful start to December, the last month in 2020. So hopefully we'll end well here for 2020 and get started with a brand new year in just a few weeks. Wanted to go over a couple different issues here in terms of VITA. And that's going to be focusing on our Pennsylvania and local taxes. We're also going to be getting into a brief discussion on deceased taxpayers. And then we're going to take a quick break and get into a discussion on any military issues. If anyone would like to go and become certified in military, the military certification. So just wanted to be sure that everyone is able to see the screen effectively, and we'll continue on through the process here. Okay, so wanted to talk a little bit about Pennsylvania filing requirements. So what we look at for Pennsylvania is you have to file a tax return in 2020 if you have gross income in excess of $33. So it doesn't matter if the individual is going to qualify for SP, tax forgiveness or not. If they have more than $33 of gross income in 2020, they are required to file a Pennsylvania income tax return. They're also required to file if they have a loss from any transaction. That would be a sole proprietor, partner in a partnership, or an S corporation shareholder. So that would also need to be filed in order to protect any losses that could affect basis in those entities. Now, the one interesting part is Pennsylvania does not have a minor rule. So anyone, regardless of age, if you have an 8-year-old who happens to have income in excess of $33, they would need to file a Pennsylvania income tax return. So it doesn't matter if they're claimed as a dependent on a federal return. There is no age limit for a Pennsylvania, or age requirement, I should say, for a Pennsylvania return. One of the other things we take a look at here as well is for Lancaster County, you would also need to file a return if you lived in Lancaster County or a portion of the Octorara School District in Chester County for all or part of 2020. So any part of the time you lived in that area and you actually had earned income or net profits in 2020. So what we mean by earned income is traditionally wage income. So that's any type of income from employment. Or if you had a transaction as a sole proprietor, again, what we mean there is a Schedule C, or you're an active partner in a partnership. So any type of earned income would require you to file a local return. Now, fortunately, with the Lancaster County return, we do have an exclusion for anyone who is 16 who's under the age of 16. The tax only applies if you're 16 and older. So if you're under the age of 16, there is no filing requirement. And hopefully the employer is not withholding local tax. If you do get a situation where someone brings in a W-2, you can file a return for refund purposes to have that money refunded. One other point I want to make about the local return is particularly if a client brings in a pre-printed form from the Lancaster County Tax Collection Bureau, we should go ahead and file that return even if it's zero. One thing that the Lancaster County Bureau will do is typically send out notices. They've been doing that for about the past 2 months here, just reminding taxpayers if they have not filed a return yet. They can still impose a penalty for failure to file, even if there is no tax due. So it's important that even if we have no tax liability, that if you see a client coming in with a pre-printed form, that we submit that back to the department. And there are a couple check boxes you can put on there as a reason why that they are no longer subject to local earned income. And that could be reasons of retirement, disability, maybe not working. There is a deceased box on there. And like I said, we'll talk about deceased taxpayers later. I've checked the deceased box a couple of times for myself, and somehow I still get a pre-printed form each year. So I guess the deceased doesn't always work. But it's just one of those reasons why we do not have earned income for that year. If it's one of the ones where it's been a couple of years since they have not had earned income, hopefully Lancaster County will then take them off the tax rolls. But if they have recently retired or they continue to get the pre-printed forms, we should go ahead and file a local return for them. Now, what's unique about Pennsylvania, there is a couple things that we want to talk about. Well, first of all, we do not have a 4012 for Pennsylvania. We actually have a separate manual for you to look through for Pennsylvania tax issues. So want to really kind of go through how Pennsylvania is basing their information. So Pennsylvania itself only taxes income if it falls into various classes. So what we're looking at here, the first class we look at are wage income. So wages are going to include any of your earnings from an employer. This is also the section where if you have a distribution from a retirement account and it's a early distribution under the age of 59 and a half, code 1 or code 2 theoretically on the 1099 box 7. This is where those would ultimately end up. They would be reported on a form W-2S and ultimately come across as wages. The next area of income would be interest income. Then we have dividend income, and then we have business income. So business income, all these categories are within scope. The one interesting part, as we mentioned, we cannot prepare returns that show losses. If we did have a loss for Pennsylvania purposes, whether for the next two categories, the business income or gains and losses from the sale of property, they do not offset other income. So Pennsylvania is only going to add positive numbers. So if you take a look at the tax software and maybe you have a loss on the sale of securities, which could happen, whether that's stock, bonds, other type of property, and it appears that they did not take the loss into account when they're adding up Pennsylvania taxable income, that's correct. Pennsylvania system's a little bit different. They only add positive items. The losses cannot offset other categories of income. Another unique aspect is even though the return looks like it's a married filing joint return, it is married filing jointly for convenience only. So spouses' losses cannot offset each other either. So an example would be if the taxpayer had $1,000 of gains from their stock portfolio and their spouse had a $500 loss on the stock portfolio as well, we would only show $1,000 on the front page of the PA-40. The spouse's $500 loss will not offset the spouse's $1,000 income. A couple other things that we take a look at, the next two areas, rents and royalties and estate and trust income, are outside the scope of VITA, so we will not have any income in those categories. But we do prepare returns for gambling and lottery winnings. So the gambling winnings are taxable no matter where they are purchased at this point. If you have a lottery, those prizes are all going to be taxable in Pennsylvania, irrespective of whether it's a Pennsylvania lottery or a national lottery like Powerball or Mega Millions. Quite often, you'll see a form coming from either the lottery or the casino. Again, it would be taxable for federal purposes and should flow over for Pennsylvania purposes as well. Now, a lot of questions we get with Pennsylvania is what is not taxable? And Pennsylvania actually is a fairly nice state for retirement because it does not tax a lot of our retirement type benefits. So what we mean by that, it does not tax Social Security. It does not tax railroad retirement benefits. Pension and retirement distributions are also tax exempt, provided that the individual has met retirement age. So if they have not met the retirement age, again, we're looking at an early distribution from the plan. What's going to happen at that point? It is going to be taxable, and what occurs in that stage is it's going to be really a cost recovery mechanism. We had discussed that a little bit during the income session, but we do get to recover our cost in a retirement plan. What we mean by cost is the amount of money that the employee had contributed from their taxes. And we'll take a look and see why that's different here in just a minute. Now, the good news is unemployment compensation is not taxable for state purposes. So we are expecting to see a lot more unemployment compensation here for the 2020 returns that is not taxable for state purposes. Same thing for sick pay and disability payments. Any alimony is not taxable, much like with federal purposes. Inheritance and death benefits are not taxable either. And active military duty pay is not taxable as well. Now, one caution, and we will talk about this a little bit in the military section after our break, is that quite often the military W-2s will be correct for Pennsylvania purposes, but may not be correct for state purposes. So we may need to make some modification there. Now, taking a look at the compensation a little bit in further depth. We do have our gross compensation. Again, that's going to go to the wage line of the PA40. And what you'll see is a form that's going to generate, it's called a W-2S. And what this does is it actually summarizes the information from the W-2s, which allows for electronic filing of the Pennsylvania returns without attaching any W-2 information. It provides sufficient detail for Pennsylvania to be able to access and verify the information off the W-2. One item that you will notice, if you haven't noticed it yet, when you prepare a return within VITA, oftentimes the state wages may be different from the federal taxable wages. And that is not an error. Even though VITA, the tax layer software is going to assume that it's an error, it will give you a warning diagnostic every time that the amount in box 16 does not match the amount in box 1. And the reason why these amounts are different is typically if we take a look at box 12. If the employee has contributed to a retirement plan and has elected to defer their own pay to our retirement plan, Pennsylvania will not grant a tax deduction for that. So the wages are actually going to be higher for Pennsylvania than they would for federal. And the reason why is because Pennsylvania does not tax distributions from a retirement plan. So if they don't tax the distributions, they're not going to allow a deduction for the contribution. So a little different from federal. Federal will give you a deduction for the amount that you contribute, but the full distribution is taxable. Pennsylvania goes the opposite way. So just a reminder, when you enter the W-2 information in TaxSlayer, go ahead and do that on the W-2 worksheet. Just be sure that you may have to update the correct state wages. Oftentimes it's going to try and automatically assume that box 1 is your state taxable. You will need to go ahead and enter the information as it's shown in the W-2. So the state wages are on box 16. State withholding will be on box 17. And just kind of a little cautionary note, oftentimes employers may add more information on the W-2 that is what is needed, and it may be in the wrong area. So if you take a look at the local wages for local tax purposes, local wages should be the exact same amount that's in box 16. So local wages are going to be taxed at the same area as state wages, so it should be the same amount. But sometimes employers may put in things like the local services tax or the PASUI down on boxes 18 and 19. So just disregard those. The ones that we want to take a look at are really the actual amount of local wages and the actual local withholding, which will be reported on box 19. A couple other issues we want to just talk about. With COVID, we're not seeing as much people crossing state lines to go to work, although that is still permissible even under some of these stay-at-home restrictions. Now, what is unique about our neighboring states is that typically we have reciprocal agreements, meaning that if an employee lives in Lancaster County but works in Maryland, the Maryland employer can actually withhold Pennsylvania taxes instead of Maryland. So it's called a reciprocal agreement. And it's generally the states that are right around us, although the very first state on the list is Indiana, which is not contiguous to Pennsylvania. So I'm not quite sure who's commuting to Indianapolis on a daily basis, but if they are, they can have Pennsylvania tax withheld instead of Indiana state tax. But it does include Indiana, Maryland, New Jersey, Ohio, Virginia, and West Virginia. So if a client is working in those states, they should have PA tax only withheld. If for some reason they have an employer, say in Virginia, that withheld Virginia taxes, they actually need to file a return in Virginia to go ahead and request a refund. So an out-of-state return has to be filed to get a refund for those taxes paid. What would happen for Pennsylvania purposes is they would need to file the return, report all of the Pennsylvania taxable wages on their PA 40 and pay the amount to Pennsylvania. So they do not get a credit for the wages, the taxes paid on wages in those reciprocal states. Likewise, we have two neighboring states that we do not have a reciprocal agreement. Those are Delaware and New York. If someone has those states that they have worked in, they would also need to file an out-of-state return and report the amount of income. Now, as a cautionary note, we do not have the capacity to prepare out-of-state returns within the VITA program. The multi-state environment's a little bit more complex within TaxSlayer, and for VITA, we are not able to prepare those returns for out-of-state other than Pennsylvania. Now, one area that we do take a look at, so generally we talk about Pennsylvania will only tax positive items. There are a couple deductions that can be taken. One of the more common ones is going to be the Pennsylvania Schedule UE, which is unreimbursed employee expenses. So Pennsylvania does allow a deduction. So you do not need to file an itemized deduction or Schedule A for federal purposes to be entitled to the PA Schedule UE. And that's great news because you actually cannot deduct unreimbursed employee expenses anymore for federal. We used to have the Form 2106, but that is no longer in use because we do not have a deduction at the federal level. However, you can still enter information for the unreimbursed employee expenses to be deductible on the state return. A couple of things that you have to keep in mind. The expenses have to be ordinary, they have to be customary, and they have to be generally accepted in the industry or occupation that you work. So what we're looking at here is that you may have expenses incurred for your occupation. Well, it would probably be ordinary, customary, and accepted in the industry that you may need non-skid shoes for maybe work in the service industry, or maybe you need a certain area like uniforms for working in a medical field. Those are ordinary and customary. What would not be ordinary and customary is if you try and deduct things like magazine subscriptions for contracting business. That's not ordinary and necessary. They have to be actually paid while performing the duties of your employment. So they have to be basically used in your context of performing a job. They have to be reasonable amount and not excessive. Generally, we don't have too many problems with the reasonableness in nature. It would just prevent you from trying to go to Europe for a business trip and you decide to take a luxury cruise rather than fly over. That would be excessive. It does have to be necessary for you to perform the duties of your employment and has to be directly related to your occupation or employment. So these could be things like opportunities where you may have to pay for things out of pocket. Common expenses that we'd see for unreimbursed employee expenses are going to be union dues. So the one thing I want to point out is we typically have a lot of educators that would qualify for the Schedule UE because typically an educator may have union dues that they're going to pay to their local union. The other thing that actually comes into play is our educator expense deduction. So if we were able to take that on the federal return, you may actually use that as an unreimbursed employee expense as well. Now for federal, there's a $250 cap. There is no cap for Pennsylvania purposes. So whatever amount they have for unreimbursed school supplies can actually be used on the PAUE. A couple other things, again, are going to be work clothing and uniforms. So again, what we're going to be taking a look at here are areas where these are going to be required for the employer and not adaptable to general use. So things like medical scrubs would be falling into this category. Safety equipment would fall into that category. What does not fall into that category would be things like if you would be in an area such as masonry and you decide you'd like a very nice warm winter jacket to wear while you're at work, and that jacket can also be used while you're off duty or while you're up walking around through the woods. If it can be used outside in general use, it is not considered work clothing and uniforms. Small tools and supplies count as well. So if you have small tools that you have to purchase for your employer, supplies like we mentioned about kind of areas here with our educators, those can come into play as well. Professional license fees that are not reimbursed by the employer can be deductible as well. So oftentimes we may see people in the medical profession that may have to pay for professional licensure or maybe continuing education. Those costs can be deducted if they're not reimbursed by an employer. Professional and also the vehicle expenses that are not commuting costs. So if you are traveling out of the area for work, again, not commuting costs, what would happen at that point is you could deduct the mileage as long as it's not a commute. That can be deductible. Same thing with parking, tolls, transportation, any travel expenses while you're away from home overnight, and meals and entertainment. And in this case, you actually get 100%. For Pennsylvania purposes, what would happen is you get 100% of the meals and entertainment. For federal, it's automatically limited to 50%. So just a couple cautions with the unreimbursed employee expenses. This is actually an area where the Pennsylvania Department of Revenue may be asking for additional information. So one of the unique aspects here with the Pennsylvania UE is if you have the opportunity to request reimbursement from your employer and you choose not to do so, the Commonwealth will not give you a deduction. So they will ask questions as to whether or not these expenses were allowable for reimbursement by your employer. So for example, if you went and had a meal with a customer, and typically your employer would allow that to be charged through and you get reimbursed, and you decided you didn't want to turn in the receipt, you do not have the opportunity to claim that on the Schedule UE. Same thing would apply if, for example, if you have a salesperson and they say that my employer reimburses mileage, but they only give me 10 cents a mile, not the full IRS amount. Well, that is not an additional deduction. If your employer provides reimbursement of any kind, even if it's less than the maximum, Pennsylvania will not grant a Schedule UE. So we just want to be cautious. We don't want to go through and create problems for taxpayers. If there are genuine unreimbursed employee expenses, by all means, they're entitled to take those. But we just have to have an eye of caution when we take a look at these unreimbursed costs. A couple other things that we want to take a look at in terms of other areas are going to be our interest. So interest may be slightly different for federal purposes than it is for PA because Pennsylvania does not tax the following sources of interest income. So that includes U.S. government interest, which is savings bonds, that type of thing, are not taxable for state purposes. Also, any interest income from the Commonwealth of Pennsylvania. So if you have any interest from PA, not taxable for the state. Also applies to any municipal governments of Pennsylvania. So typically what we see are investment in municipal bonds. So if someone has bought, for example, a school district of Lancaster bond for building or improving a school, the interest from those bonds are going to be tax exempt for federal and for Pennsylvania purposes. Likewise, if they actually have any bonds or obligations from Puerto Rico, the Virgin Islands, or Guam, they would also be tax exempt. Sometimes you may need to make a modification if there is something that would be taxed for federal and not taxable for Pennsylvania. You can actually enter that amount in the tax exempt interest worksheet by clicking on the add or edit button. And then simply you just enter the amount of PA taxable income in the amount. So you may have to do that if they don't follow exactly from federal carryover purposes. Now, one of the big things that we always take a look at here is Pennsylvania tax forgiveness. So a lot of our clients within VITA may qualify for tax forgiveness. It's actually a chart that's based on the amount of income, how many taxpayers and how many dependents are part of the return. And that allows eligible taxpayers to reduce either all or part of their Pennsylvania tax liability. What's unique about Pennsylvania is we have a statutory tax rate that is a flat tax, 3.07%, irrespective of your level of income. Whereas for federal, they have graduated tax rates. One opportunity the PA has to essentially work around that restriction is to grant the tax forgiveness program. So if taxpayers have income that falls underneath those thresholds, they can either have all or part of their taxes reduced. Now, there are certain elements that we have to add back. So certain elements of non-taxable income have to be added back in the calculation. Now, the alimony should come over on its own, but there are a couple things we may need to take a look at. We may need to modify for non-taxable interest, things like inheritance, that has to be added back. Things like our non-taxable educational assistance, things like if they had any scholarships, that would need to be added back in. And another big one that can sometimes catch up to taxpayers who are unaware is the excluded gain from the sale of a personal residence. So oftentimes when you have someone who might be downsizing, maybe they're moving out of the home that they had lived in for years and are going to move into either a smaller place or maybe an assisted living facility, they will typically sell their residence. Now for federal, we don't really worry about that too much because you have a $250,000 gain exclusion, $500,000 if married filing jointly. But unfortunately for PA purposes, you need to add that amount of excluded gain back for SP purposes. So for the year of sale, we may end up in an unfortunate situation where the taxpayer may owe Pennsylvania taxes that they were not necessarily expecting to owe. And again, that only is if they have other income taxable for PA purposes. Now, if a taxpayer is a dependent of another, so you may be preparing a family set of returns and you have a child coming in and based on their income level, it looks like they would be eligible for tax forgiveness. They would only be eligible for tax forgiveness if their parents are also eligible for tax forgiveness. So it's important that we double check that if we try and take a tax forgiveness for someone who's a dependent on someone else's return, that we also can verify that the parent was eligible for tax forgiveness. One other little reminder for tax forgiveness, if the taxpayer is going to file married filing separately, you do have to include the spouse's income to determine eligibility. So that might be another area that we need to take a look at as we go through the process, just to make sure that we have all the income accounted for. Okay, a couple other issues I just want to talk about for Pennsylvania. One thing to watch out for are annuities. So annuities are effectively a retirement type vehicle. These are basically non-employer based opportunities. So an individual may purchase a privately commercialized annuity. Generally, these are probably coming from an insurance company or a mutual fund company, or potentially a gift annuity. Any earnings coming off of these non-employer accounts, these annuities, are considered interest income and are taxable for Pennsylvania purposes. So generally what we take a look at is the amount shown on the 1099-R will be considered taxable for Pennsylvania purposes. The administrator should go ahead and calculate the amount that's considered a return of capital and also calculate the amount that's considered earnings on that annuity. So the one thing to watch out for is on the 1099-R, box 7 is going to have a code 7D. If you see the 7D, the 7 part means it's a normal distribution. So normally not taxable for PA purposes, but the D is going to indicate it's coming from a privately purchased commercial annuity, which means that the amount shown as taxable will be also taxable for Pennsylvania purposes. So just be aware that that might be an issue that we need to address for anyone who has a privately purchased annuity. Another little interesting aspect for Pennsylvania purposes is there's a question on the return about use tax. Now, the benefit is we don't have the client in front of us this time to actually ask the question and have that blank look coming back to us to ask what is use tax. Well, use tax is actually a corollary to sales tax. So when we take a look at purchases made in Pennsylvania, if the item would be taxable in PA, the retailer is going to collect sales tax from the customer and remit that to the Commonwealth. Well, being the fact that we are relatively close to a state that announces that it's a home of tax-free shopping on the Welcome to Delaware sign, there's an opportunity for people to have avoided paying the appropriate amount of sales tax to the Commonwealth. And that is an opportunity for them to voluntarily report. It's a completely voluntary question. There is no penalty for not filling out the use tax. There is no compliance opportunity for the Commonwealth to go after individuals for failure to pay use tax. So this is really a voluntary position. You can put zero down. I believe most of our clients have. I think every year we ask, and there may be a handful of clients that actually do report that they have use tax based on out-of-state purchases or maybe things they've done online that have not been taxed. If you know the exact amount, you're more than welcome to put that in. I had an engineering client a couple of years ago that would diligently go through all of her receipts and indicate when she bought something out of PA and would have me enter that information on the return. If you don't have a detailed list, you can actually go ahead and allow the state to calculate it for you. And this gives you the opportunity, if you have $15,000 or less of income, they're going to add a $6 balance due. Between $15,000 and $3,000, it's going to be $12,000. Between $30,000 and $50,000, it would be a $17 tax due. Basically, what these are a contribution to the Commonwealth of Pennsylvania revenue funds. So there's no deduction for these. It's just an opportunity for someone who feels that they would like to pay more taxes to have that opportunity on a voluntary basis. Now, a couple other things I just wanted to talk about here for Pennsylvania is there are a couple deductions that can actually come into play. So we talked a little bit about Section 529 contribution. So a taxpayer can actually deduct up to $15,000, or if they're filing jointly, each spouse can take $15,000 in contributions, and this is per beneficiary per year. So the 529 plan does not have to be a Pennsylvania plan. It can be a plan anywhere that accepts a 529 contribution. And you do not need to claim the beneficiary on your tax return. So this could apply for grandparents and aunts and uncles and others as well. So what we take a look at here is having that opportunity to go ahead and take a deduction. Now, generally what we need to have is the information from the individual who's part of the plan, which would include their name and their social security number. So we do need that information in order to take a deduction. Now, the other little issue we have here is the deduction is the lower of the amount of the contribution. So again, up to $15,000, but if you only contributed $4,000, our potential deduction's $4,000, or Pennsylvania taxable income. So if you don't have any Pennsylvania taxable income, if you have no income other than Social Security and retirement distributions, you don't have any Pennsylvania taxable income. So unfortunately, you cannot take a deduction for PA. One of the other opportunities we have is the HSA contribution. So a taxpayer, if they are taking a federal deduction, again, Form 8889, if there is a deduction on the federal side, that will carry over for Pennsylvania. So any contributions that someone's done on a pre-tax basis or made by the employer do not qualify. These would be your taxpayer contributions to the HSA and would be deductible on the Pennsylvania return. So what we would take a look at here, the last one is a Pennsylvania ABLE account. And this is a program designed for savings accounts for individuals who have disability-related expenses. So this is actually, the acronym stands for Pennsylvania Achieving a Better Life Experience. So a savings program intended to help cover costs for people who have disabilities. Now, the nice part about the PA ABLE program, a couple things. One is all funds are tax exempt. So there's no state taxation on any of the earnings. Any undistributed earnings are not subject to tax either. The other nice part is it does not impact the ability for the recipient to, they can still qualify for their government benefits. It does not preclude them from still getting the benefits from federal and state organizations. So the taxpayer can deduct up to $15,000 of contributions per beneficiary per year. Same thing with the spouse. Now, one thing to note here about the contributions is the Internal Revenue Code limits the amount of annual contributions to only $15,000 per account. So we can only have $15,000 per account go in. So we're going to be capped at some point there on the $15,000 per beneficiary. Now, if you have multiple people you're contributing for, you can deduct up to that $15,000 for each. Now, the deduction again is going to be the lower the contribution or the Pennsylvania taxable income. Now, in order to deduct any of these amounts, you would have to attach the PA Schedule O to the return. That's going to, in TaxSlayer, automatically follow and be eligible for electronic filing. Again, we do need to get the information from the beneficiary, so we do need their name and social security number. So those are kind of the issues that we take a look at. Yeah, as we said, the Pennsylvania ABLE contributions, it will not affect any of the government benefits. So the SSI and Medicaid are not going to be a problem with the PA ABLE accounts. Okay, so taking a look at a couple other things I just want to remind you of for Pennsylvania. One area that we do need to go ahead and verify is the school code. So we do have a listing of all the tax codes. Hopefully the taxpayers know what school district they live in. If not, we have access to a municipal stat lookup service, which will actually give you the current residence code, not just the school district, but also for local purposes. So we have the effective code. One thing you want to take a look at is the tax code for school districts. The ones we use for PA purposes is a 5-digit number. The one that we would use for local purposes is a 6-digit number. So just bear in mind that the school districts may have different municipalities within there. So the code may be slightly different depending where people live within a particular school district. But so I have 2 pages here for you going in alphabetical order for all of the school districts, either within Lancaster County or like with Octorara, bordering on Chester County as well. So just a listing, and that'll be available for you in your state manual as well for you to be able to update the codes effectively. All right, wanted to finish off on a strong note here with Pennsylvania and taking a look at our property tax rent rebate. One of the main reasons we have a lot of seniors come in for our program is to have us help them file the PA rent rebate, PA property tax rent rebate form, the PA 1000. So the program benefits Pennsylvanians in 3 distinct categories. One is any seniors age 65 and older, any widows and widowers age 50 and older, and any individual with disabilities age 18 and older. So the income limitation we take a look at, if you're a homeowner, it's $35,000. Anything up to that, you still qualify. For renters, it's less than half of that. So as a renter, you can only earn up to $15,000 before it paces itself out of that rebate. Now, when we take a look at income, fortunately, TaxSlayer does a great job of pulling that information together. 50% of Social Security income and your railroad retirement benefits will be included as income. So we're going to exclude half and include half. So it's not exactly what's off the PA 40. That's not going to give you an accurate representation of income determination for the PA 1000. A couple things we have to take a look at, much like the SP. Inheritance, alimony, spousal support, and gain from the sale of a principal residence are included in income. So we need to add these amounts back. A couple other things I just want to point out when we had talked about the income section, there are a couple codes on 1099-Rs that may also impact SP and our property tax rent rebate. Those would be a code 6 and a code W, may be impacting our property tax rent rebate qualifications as well. So when we take a look at the benefits, what we have is we have a maximum standard rebate of $650. Now, what may happen is even though we request the $650, we may have taxpayers coming back and actually have gotten a much higher rebate. And that is because the state will automatically increase that rebate by 50% for senior households, as long as those households have less than $30,000 of income, and they pay more than 15% of their income in property taxes. So the state will automatically go through the calculation and would modify the amount of rebate check that the client would receive. Just to provide a chart for you, just to double check and see where we're at. For the homeowners, the maximum rebate of $650,000 is earned as long as their income is less than $8,000. Once you get over the $8,000 threshold, up to $15,000, you're at $500. $15,000 to $18,000, you get $300, and then $18,000 for the next $17,000 of income, you can still get a $250 rebate. For renters, we're only taking a look at the first two categories, the 0 to 8, again, maximum of $650, and the $8,000 to $15,000, which will get you to $500. A couple of things that we want to take a look at just as a reminder about what would be coming into play here is if we are eligible for the PA property tax rent rebate. If the taxpayer lives in Pennsylvania for the entire year, you do not need to attach the Social Security statement. That is automatically pulling over from the state, so that does not need to be included. Now, you can go ahead and submit copies of the Form 1099 to show your pension, annuity, and other retirement income. You double check with your site coordinator what they would like you to attach. You can either attach the 1040 or the PA 40 to prove income as well. So just double check with your site coordinator which way that they would prefer that to be filed. Now, if you are a homeowner, well, what you would need to attach is proof of your real estate taxes paid. So that can happen in a couple different ways. One is you can actually have a copy of a receipted tax form. So what you would need to do is to actually go to the tax office and have them stamp a copy of your tax bill as paid, and that's a receipted tax bill. If you don't have a receipted tax bill and you have a copy of the original tax bill, you can also provide a copy of both sides of your check to show that the check cleared. Now, one of the easiest methodologies, if the taxpayer actually has a mortgage and is escrowing their taxes, you can simply submit your Form 1098, which will show real estate taxes paid for the year, and that'll be sufficient for the homeowner. Now, for the renter, we have a little bit of different situation. For the renter, you actually have to have a PA rent certification form filled out. So the landlord actually will have to sign that. So it has to be a signed form that can be included with the rebate claim. Sometimes we have clients that will actually already have the form signed and ready to go, and we can just help process the return and be able to help them go through the process. One other thing that we can take a look at, if they don't have everything together, we can actually prepare as much of the form as we need and have them take that over to their landlord and have it signed. So one of the things we'll take a look at here is going through some areas of a first-time filer for the PA property tax rent rebate. So in order to prove that you are at least 65 or older, you need to have a copy of one of these following documents. A birth certificate or hospital birth records. I always love how the Commonwealth asks for a copy of this. It is a certificate that is issued within the Commonwealth. And if you've ever taken a look at a birth certificate, in clear, bold language, it says, do not duplicate, do not photocopy. But yet, Pennsylvania wants a photocopy of it to prove your age. Other things can work, copies of a driver's license, a passport, the Pennsylvania ID card. If you have a Medicaid card or a PACE or PACENet card, we can make a copy and submit that to the state to prove their age. If you are a widow or widower, we'd also need to prove age. So it's the same thing as above there. And also a photocopy of the spouse's death certificate. Again, another government issued form that says do not photocopy. For a permanently disabled individual, what we take a look at is if they are under an SSI or have Social Security disability, we should provide a copy of the award letter. If they are getting benefits for a military disability, if the Veterans Administration has determined that they are disabled under their guidance, you can provide the VA letter. Or if they don't have either one of those, you can provide a written and signed physician statement, which is a PA 1000 PS, standing for physician statement. So those are just some things that we would take a look at from a PA property tax rent rebate perspective. And just wanted to finish off the first part of our discussion with just a quick topic here on deceased taxpayers. So one of the few areas I'm going to actually point out that there is a section in your 4012 for deceased taxpayers. What we are taking a look at are if we have a individual coming in and their spouse is deceased for the year. So typically they would have been filing a joint return. They are still eligible to file a joint return. So if the couple was married in 2020, as long as the surviving spouse did not remarry by the end of the year, they can still file a married filing jointly return. So a couple things that we take a look at there are the surviving spouse is eligible to sign on behalf of the deceased spouse. So the 8879 can be signed on behalf of the deceased spouse by the surviving spouse. One point that we'd probably make to make things a little bit easier is when you're entering the tax return information, change the surviving spouse to the primary taxpayer. So go ahead and modify what you're putting in for the taxpayer information so that the surviving spouse is now the primary taxpayer. That allows it to roll over next year a whole lot easier. When you go through the process, just be sure that you check the taxpayer is deceased box as we go through the introductory information. That'll actually generate a date of death box to come up. So just enter the information in there, and then TaxSlayer is automatically going to put the correct information on the return. Now, what happens if we have an individual who comes in and there's no surviving spouse, or both spouses died during the year? Then we do need a personal representative. They're going to have to file and sign the return. So this could be an executor, an administrator, anyone who's actually in charge of the decedent's property. And if we have a situation where we have a refund for a deceased person, we have to file a Form 1310. So Form 1310 must be completed. There are a couple options in there. And again, if you have questions on the 1310, K16 of your 4012 will go over a little bit more information. But if you have a situation where either option A or option B selected on who that representative is, then the return must be filed by paper. So fortunately, TaxSlayer will always prepare all the forms that we need. That is going to go ahead and allow us to at least submit the return. The one that can be filed electronically is where we're basically taking a look at the certificate here of a court-appointed representative. So that's typically where we'd actually see that that come into play. You may get a warning, a diagnostic warning, if you're trying to file a return for a deceased taxpayer. So if we run into a diagnostic, we may go ahead and do a paper copy of the return, again, showing the appropriate documentation. All right. Again, if you have option C for the Form 1310, you can file electronically, but just bear in mind, TaxSlayer may want you to try and file by paper, just to be sure that everything moves quickly. Now, we say that quickly, but unfortunately, we're running into situations where the IRS is still processing paper filed returns from tax filing season. I think the latest update we had gotten from the IRS is there's still over 1 million pieces of mail that are unopened sitting at IRS offices. So the IRS is pretty well backed up for paper returns, which is why we highly encourage electronic filing to make sure returns are processed timely. Now, unfortunately, we may run into a situation where the return has to be filed by paper, and we may have a lot more time to wait than what we had originally had anticipated. All right, so that's going to take us to our 5-minute break here. So we will go ahead and I think start the timer for our break, and go ahead and come back right around 6:41. Michelle, Jeff, does that sound about right?
Yep, sounds good.
Okay, perfect. Questions for us here, Jeff?
Yes, there were a few questions.
Okay.
Let's see. All right, so it is my understanding that you don't need to commute daily to a job in another state to be eligible for tax reciprocity. For example, If an actor accepts a professional role at a theater in Indiana and lives in temporary housing there during the run while maintaining residence in Pennsylvania, the actor's wages are eligible for tax reciprocity?
That is correct. Yes. Right. Typically, the situation is that most of these are all bordering states, so they were really designed for convenience of people who may live in the southern part of Lancaster County and commute to Maryland, but you do not have to commute to work. If it's a temporary assignment and you're still maintaining your Pennsylvania residence, then that would also count for reciprocity. So it's just kind of an odd element that we have Indiana showing up as a state in reciprocity, even though it's not connected to PA. But yes, absolutely. If you are in a theater production in Indiana, you can have them withhold Pennsylvania taxes on your behalf and would not be subject to Indiana taxes.
And I think it is the Broadway of the Midwest.
Yes. If Branson hasn't taken over that role, then yes. So Indiana has got some opportunities there as well.
Okay. Next question. Use tax is deductible if you choose the sales tax option rather than income tax on Schedule A, correct?
Correct. Right. So yeah, if you are itemizing taxes, you have the ability on Schedule A for federal to either take income taxes or sales and use tax. So theoretically, if you're paying use tax, that would be deductible on the Schedule A if you choose that option. So particularly for people who are in states like Florida and Texas that do not have a state income tax, the sales and use tax is a popular option. Or for Pennsylvania residents who do not have Pennsylvania taxable income, you can deduct your sales and use tax as well. For the Schedule A, usually you have an option of allowing the government to calculate what they believe your sales and use tax would be, or if you have specific items, you can enter those as well for the Schedule A deduction.
Okay, thanks for that. Regarding Pennsylvania property tax, if the taxpayer is under 65 but has a dependent over 65 in their house, would the taxpayer qualify for the rebate?
They would not qualify. So the qualification rules are not based on dependents. It's actually based on the ownership of the property. So in order to qualify, the claimant themselves have to meet one of those three categories, either 65 and older, they have to be a qualifying widow or widower, or they would be considered disabled and over the age of 18 to qualify for the PA rebate.
Okay. Another question on the rebate. The title of the house is in the parents, the title of the parents' home is in the children's name, but the parents pay the taxes. Can the parents take the rebate?
All right. This is always an interesting question, and usually has arisen because of estate planning issues. The unfortunate position is once you do this, once you move the property out of the name of the parents, you are no longer eligible for the property tax rebate. So the property tax rent rebate will follow the title holder of the property, not the resident necessarily. So if the property is in the children's name, who's not age 65, and the parents live in the home, even if they pay the taxes, they do not qualify for the homeowner rebate. Now, the opposite could be true, though. If the parents lived in the home and had the home titled in their name, but the children pay the real estate taxes, the parents are still eligible. So they don't actually have to be the one who pays it. It just has to be paid on their behalf. And the most critical element is who's actually on the deed. So who actually owns the property.
All right, got that. And sorry, I did skip one. It has to do with how will we help older clients gather the paperwork for the rebate. So consistent with what we do at an on-site tax prep, the client brings the paperwork and we will scan it and make it available to the person filing the taxes. Moving down, is there state documentation like the IRS Pub 4012 to assist in doing state returns?
Yeah, and I think what we have, Jeff, is typically they have the resource manual that we've put together that will encapsulate a lot of the state topics we've talked about. Some other very valuable resources are
Your professor. Your teacher.
Yeah, everyone, it looks as if Jarrett's connection dropped. Let's just give him a moment.
His connection dropped off. Well, come on, get it back.
Okay. So we'll come back to Q&A when Jared returns, but I just wanted to give you an update for next week for our tax law number 5 session. What we will do is we will start with a Q&A with any tax related questions, things related to VITA. If you wanted to email those questions to me by end of day Monday, December the 7th, I'll accumulate them, get them to Jared, and then we will answer those at the start of our tax law number 5 session. We will also cover the intake and quality review process. We'll give you the tax slayer and client management software training schedule for January. And then we want to discuss with you our current thinking around the sites, as well as how we will be delivering services. So just know that we had a plan in place, and given the changes within the state over the past couple weeks, that has modified our thinking a little bit. So we will share where we're at with you next Thursday. All right, is Jared joined us again, Jeff?
Yes, he
I
has.
am back. Yes.
Oh, right. Do you want to start? I'll stop sharing, Jared, and you want to drive again?
Sure, that's fine. That'll work out well.
Okay, so what we're going to do now is we will move on to the military topics. So I don't know if all of you or any of you are planning on certifying military. So you are more than welcome to stay and listen. But if you're not, feel free to leave. Typically, we do not have many military returns in our program, but I just wanted to make sure that we are able to provide that service. To me, if someone's willing to put their life on the line for me, I feel that I need to be able to do their tax return. And I know personally that there is a National Guard unit from Fort Indian Town Gap that is currently serving in a combat zone. So we may see a few more than we normally would. All right, with that, Jared, it's on to you.
All right, appreciate that, Michelle. Apologize for going ahead and losing you for a bit there. Hopefully, I'm not trying to duck any questions, so hopefully it didn't seem that way. Hopefully, we're able to get through all that effectively. So a couple of things we want to take a look at from a military perspective, and hopefully the screen is able to be shown here again for you guys. You're able to see the military tax issues. This is going to be the 5th year that we are preparing military return. So as Michelle mentioned, there is a specific certification we need for the military process. So we just want to be going through and making sure that if you're interested in doing it, you can go through the testing. The one unique area here is that we don't see these all that often. As Michelle mentioned, we don't really have that many active military bases here in the area, but we do have a fairly significant amount of National Guard people. And we may see a few more that are actually elevated to active duty. So if you see one, feel free to ask for help. Also be able to share the information because, again, we don't see these all that often. So it's helpful for others to get some more exposure for that. Again, we probably won't see a whole lot of these, although I've had some experience with these as well. Worked with some Air National Guard who were deployed actively over the last several years. So we do get to find out more information about the preparation of returns. One thing I do want to mention is the 4012 is probably not your best resource for military issues. You probably would rather pick up the 4491. That's a publication that has a lot more detail on the military taxation issues. So that would be our resource we'd most likely use from that aspect. Now, fortunately, we do have a little bit of information on the 4012, at least to help you kind of get through a couple things here. So typically what will happen with the military is the serviceman or woman will receive a W-2 from the Department of Defense. Even though the government uses their lowest cost contractor to go ahead and prepare the W-2s, oftentimes they are actually accurate for at least a federal purpose. I have seen this in the past where they have not actually been correct, and it's taken a little bit of a hassle to go through and get corrected W-2s. But in recent years, these have actually been going through fairly nicely. So the federal is usually correct. And if you take a look at the 4012 on page D2, they're going to go through a couple elements of taxable and non-taxable military income. So that does allow people to go ahead and see what will be going through as taxable and tax exempt income. So things like active duty combat pay would be non-taxable, but things like your basic pay would be taxable. So generally the W-2 is going to have it down correctly. A couple other things you may see with the military is that they usually have some very unique codes, things that we're probably not going to see all that often. They may be somewhat unfamiliar in box 12. Just go ahead and enter those as you see them. A couple other things we take a look at are moving expenses. So moving expenses for non-military people are no longer deductible. That was actually removed from the tax law changes in 2017. But military moving expenses, which we'll talk about a little bit later, could potentially be deductible. The other thing we want to mention too is that service military individuals can take unreimbursed employee expenses. So they can actually take those on Schedule A. So they are still allowed to take those even though others are no longer able to do so. So just kind of going back to the military income a little bit. So again, generally box 1 of the W-2 is going to have all of the relevant information. Some things that can change over time is taking a look at severance pay versus disability compensation. So severance pay, if you are being paid by the military and your separation is due to medical reasons, and the military calls it severance pay, that separation pay is taxable. What often happens is the former serviceman or woman will appeal the decision, and you can appeal that in front of the Veterans Administration. And if they determine that your separation of service is actually due to disability and not just a severance compensation, then they will actually award a disability compensation letter. So once that letter is awarded, then the compensation is not taxable. So if you have a disability compensation, it's non-taxable income. So it may just take a little while before the military catches up to that. And what would theoretically happen is you can actually file an amended return to go back and pick up any items that were shown as taxable on your return and treat them as non-taxable back to the date of the VA determination. So you may have an amended return aspect there. So usually it's only going to be a problem or an issue in the year in which the disability letter is received. Other than that, it should generally be fairly cut and dry. Now, again, with military pay, if you're serving in a combat zone, the combat pay is excludable. Now, what's unique about combat pay, it's not going to be taxed in box 1, but it is going to be listed in box 12 with the code Q. So the code Q is going to be indicating it is not taxable for federal purposes. However, combat pay is going to be considered as eligible income to help increase earned income credit. So it does allow us to go ahead and use that combat pay, even though excludable, can be used to help boost the EIC opportunities there. So a couple other things, the homeowner assistance and basic allowance for housing, the BAH, are not taxable and not reported as taxable income. Some circumstances, we may have some issues here with moving expenses paid by the military as taxable. Again, I'll talk about that in just a little bit here with some military questions. Other things what we want to take a look at are falling over to the state and local side. As we mentioned, compensation earned by PA residents is generally going to be taxable. What is not taxable is going to be any active military duty pay earned while stationed or training outside Pennsylvania. So a couple things that we have to take a look at there is we're looking for active duty pay. So it's going to be active duty pay while they're outside of Pennsylvania. So that includes any active duty for training or any active duty reporting outside Pennsylvania. Any income received by a resident for military service inside Pennsylvania is fully taxable. So it actually has to be earned while outside of Pennsylvania. Now, one of the things I mentioned is that oftentimes the W-2 does not have the correct amount reported or may not have the correct amount of Pennsylvania tax withheld. What typically we need to do in that case is actually send the W-2 and a copy of the military orders. Or if you don't have the military orders, if you have your CO statement, you can send that with a return. Now, the nice part is you can still file electronically, and there is actually a way that we can either fax or scan and email the information, upload that to the Department of Revenue. So you don't actually have to physically mail everything, although if you would like to, you certainly can do that. The Department of Revenue is actually checking mail and a little bit more responsive than the IRS even during COVID. So a couple things that we want to take a look at there. If you have any questions, the PA REV 612 is a great brochure on taking a look at military service. A couple things we take a look at for those of you who might be more familiar with the Reserve and National Guard members. If you have to take a look at your Title 10 or Title 32 active duty pay. So again, just taking a look there, provided that you are traditionally going to be on active duty and outside of Pennsylvania, not taxable. Active duty inside Pennsylvania will be taxable. A couple other things I just want to mention as we get into the moving expenses. So moving from one station to another, basically what we call a permanent change of station, are deductible expenses. Typically not something we see here in Lancaster County, as people are not moving because we don't have any bases here in Lancaster County. But perhaps we are working on a return for someone who has a child who has moved to another base, or perhaps you have a parent who is a child in the military, or their child is married to a military service person. What we're looking at here is the cost of moving the household goods and personal effects, along with our aspects of reasonable travel and lodging. Those are all going to be deductible expenses. So what we're looking at there is the cost of moving your items. Usually the most direct route would be deductible. So typically what will happen is that these are going to be paid by the service member or their family. The military will typically reimburse, and we'll talk about what we call personally procured move in just a second. But the qualified amounts over the reimbursement are deductible expenses. Now, if you run into a situation where a individual has submitted expenses and they're going to be reimbursed later, what's going to happen in that case is the reimbursement will become taxable. So if you take the deduction in 1 year and you get money back in the next year, that reimbursement will be taxable. So if we are seeing any military move expenses, we do fill out the form 3903. That form was for any moving expenses. It's now reserved only for military moves. Now, as I did mention about the personally procured move, the PPM, it used to be called the DITI, basically do-it-yourself move. If you're actually deciding to move yourself and you tell the government that you will take care of transporting your items from one location to another, the government will go ahead and provide you 95% of the cost of their moving process. So the government will determine how much they would have incurred to move you, and they will allow you to get up to 95% of that cost. Now, what you have to do, you have to submit all of your receipts to the government to substantiate your actual expenses. So while the government's going to give you 95% of what the cost is for them to move, if you actually saved money, if you actually got more money back from the government than what you actually incurred, that excess amount is actually taxable income, and it's going to be reported on a separate W-2. Now, however, bear in mind any other amounts, the meals, the lodging, in excess of any reimbursement may be deductible on that 3903. A couple other things that I want to just mention here concerning military business expenses. So you do get a deduction for any costs incurred for military business expenses. Again, same rules apply. They have to be ordinary and necessary. They have to be a reasonable amount. They have to be incurred while performing your military duties. So these can include things like unreimbursed uniform expenses. That includes cleaning. They can be deductible as long as the uniforms themselves are required for employment and cannot be used for general use. Generally, what we see for military uniforms is they have to be specifically prohibited for off-duty wear. So if you're not allowed to wear them, off base, you cannot take the deduction for cleaning. Travel expenses. So what we sometimes see is for people who are going away for reserve duty, if you are traveling more than 100 miles, those can be deducted as an adjustment to income. So it is a 100-mile rule. So if you're traveling for more than 100 miles, you actually have the opportunity to deduct your travel costs to get there as well. That includes if you are required to stay off base. If there's no base housing, that can also be considered a deductible travel expense. Professional dues, if you have to have dues while you're in the military, follow the same rule as a general expense. They have to be ordinary and reasonably and customary. They have to be related to your occupation. So therefore, personal and social dues like officer club or NCO dues are not deductible. A couple other things that we take a look at, the education expenses can be taken as long as they are required. So if you have to take training courses, what we're going to take a look at there would be if you have to take additional certifications. So quite often we may see that for things like pilots and mechanics, as long as they are qualifying you for your current trade or business, they are considered deductible. And the 4491 has a fairly long list here of what is deductible and what's not deductible. So the 100-mile rule, taking a look here, it would be a one-way move from your home to the base that you're reporting to. So that's how we determine the 100-mile rule. All right, so the military section is pretty quick. Again, what we want to take a look at here, there are some unique elements here, really mainly on three different aspects. The military pay, and again, we may have some adjustments we need to make for Pennsylvania purposes, the ability to deduct moving costs, and again, that would be the cost of moving your household items and your transportation costs. So any of your other personal costs not deductible. And then military business expenses would be any of those costs to travel for reporting for reserve duty, potentially your uniform cleaning aspects. As long as you are not reimbursed for any of those costs, it can be considered military business expense. If you have to go pay for certain required items like insignia of rank or core devices, epaulets, swords, those types of things, those are technically deductible as well. So again, main area we want to consult is the 4491 for additional detail. And we'd be happy to take some questions at this point if we have those, either things that have occurred since our last question break or anything more specifically going through our process here.
Sure. So there were some questions from the military section. Is active military duty pay taxable to local?
The active military duty pay is typically not taxable for local if it is earned outside of the area. I will double check that. That is an area that you kind of, as we go through the entire process, what typically happens is we end up getting the feds do pretty well on the federal income. They don't do so well on the state income, and they really don't do well on the local income. But typically what we take a look at here are, it's probably going to depend on the type of pay that they have. So really, when we take a look at the wages, typically local follows Pennsylvania for the most part. There are a couple slight changes, but typically what we would be taking a look at here is if it's active military duty pay, not earned while in Pennsylvania, that can typically be exempted as well. But I will clarify that if we have any issues.
Okay, thanks for that. Next question. For Pennsylvania, are retirement contributions made by service personnel taxable from military while serving on active duty?
All right. So I guess the question being if the wages are federally non-taxable, would Pennsylvania still tax the retirement aspects? And that's a great question, because it would depend on whether the wages were properly segregated. Typically, if Pennsylvania is going to consider you here as a resident of PA, I believe that they are going to try and tax those withholdings as income. But this is where we get into some of those unique areas. So if you do run into that, we can do a little bit more research and show you how to do the allocation of those. We have done that in the past, where we've allocated not just the combat pay, but also the withholding related to that pay as well. We've had some success. Sometimes we run into issues with PA trying to deduct those.
All right. Are meals for military moving deductible?
No, I'm sorry. I may have misspoken when I talked about the meals for military moves. So the meals are typically not deductible. It's actually your travel costs. So typically your transportation costs of moving.
Okay. And then I think you did cover the 100-mile drive for military travel. When you dropped off, Jared, the question was related to, is there a state 4012?
Okay. Yeah, and we don't actually have a state 4012, but what we have in the past is we have typically a VITA resource guide that will contain a lot of the information that we discussed within our training today. Is that something, Jeff, that you and Michelle were going to be putting together again for 2020?
So yes, we will be, not hard copy. We will have it just like we did last year. It will be a Google document that will be available to everyone, and we bookmark it on all of the Chromebooks.
Okay, perfect. So again, some other resources that I may have cut off before I was able to describe those. The PA 1000 instruction booklet is actually fairly easy to walk through. And provides a lot of good information and some resources. I know we had a couple questions about home ownership and who owns title. It also addresses some of the questions we may run into where people may be in a mobile home community and they may own their mobile home, but they rent the land. So they're actually in that home owner, home renter classification. So the instructions for the PA 1000 actually provide a lot more guidance as to what the state's looking for.
Okay, I think those were all the questions.
All right, then I'd like to thank everyone for joining us. Remember, 4012s and test booklets will be available through about 4 o'clock tomorrow at the United Way offices located at 1910 Harrington Drive, right above Nito Burrito off of Fruitville Pike. And remember to get any questions you have for Jared related to VITA tax questions emailed to me. We will get them to Jared, and that's how we will start our session next week, going through those questions. Have a great rest of the week, everyone.